Something just happened on global stock market indices that hasn't happened since 2020, and before that, the 2008 financial crisis. The VIX, which measures the stock market volatility in the United States, rose to a level that we've only seen twice over the last 30 years. Once in 2020 during the COVID crash, and once in October of 2008 during the largest stock market decline since the Great Depression. The VIX spiking above 45 is something that has only occurred 6 times in the last 30 years. These periods of elevated market volatility mark moments of extreme investor panic. They reflect a deep sense of fear regarding the future of the economy and financial markets. Within just 3 days, the global stock market index fell by 8%, a very impressive decline. Some indices, like Japan's Nikkei index, fell by a staggering 20% during that 3-day period. Could it be that this extreme volatility is something that investors should actually take advantage of? We'll provide you with everything you need to know to understand what's going on today. If we first simply overlay the global stock market index against this volatility index, we see that many of these spikes in volatility do actually coincide with significant market bottoms. That was the case, for example, in all of these instances right here. These are great examples of how moments of extreme panic in the market can actually mark bottoms in stocks. Stocks tend to decline as volatility spikes, and then when volatility peaks and begins to come back down, that's typically when you see stock market indices rise. So whenever volatility is this elevated, the risk reward is generally better for buying stocks because volatility mechanically has more room to come back down. But it's far from being a perfect formula. In 2008, for example, market volatility spiked to around 40, the same level as today, on the 26th of September, 2008. But you can see the VIX stayed very elevated until March of 2009, a 5-month period where global stock market indices actually continued to move down by around 40%. Fast forward to 2020, and we have a similar scenario where market volatility spiked to 40 on the 27th of February, but it continued to rise until the 18th of March. Over the course of those few weeks, we saw the stock market drop by another 20%. So that shows us that although it's generally more attractive to buy stocks when volatility is elevated, the truth is that volatility can stay elevated longer. When volatility spikes to these extreme levels, it means the stock market is experiencing wild moves. Now that can mean a massive recovery, but it could also mean extreme downside. The only way to determine which one it's going to be is by figuring out what has been driving this spike in volatility and whether this is just a temporary panic or if volatility is going to stay at these elevated levels, causing further downside in stocks. In 2008, this initial spike in volatility was when Lehman Brothers collapsed. But that event actually led to a series of other bank failures and rising unemployment around the world, keeping volatility at these elevated levels for months. In 2020, the initial spike in volatility occurred when lockdowns started as a result of COVID-19. But volatility continued to increase until global central banks stepped in with large amounts of liquidity in order to stabilize financial markets. Both the 2008 and 2020 sustained spikes in volatility were a result of a global economic downturn playing out. You can see both of these spikes in volatility in 2008 and 2020 occurred during global recessions that are labeled by these gray bars. So if the global economy is currently headed into a recession, that would be the argument for seeing volatility stay at these elevated levels, just like in 2008 and 2020. Indeed, the United States unemployment rate just rose to 4.3%, showing quite clearly that job losses are starting to pick up in the US, which is typically something that's only seen during economic downturns. A recession in the US usually means that the rest of the world is also going to experience a recession. That's because Americans make up a staggering 29% of global consumer spending. So if these US consumers are losing their jobs, you can probably expect that the rest of the world is going to feel an economic impact. Another recessionary signal we recently got is on this chart right here, showing a steep decline in durable goods orders, the largest decline since the 2020 recession. Declining durable goods orders is typically something that you see during recessions. This type of decline in durable goods orders is also typically associated with declines in the stock market. Whether you look at the DAX, the German stock market, the French stock market that also saw considerable declines during these periods, or the UK stock market, all of them go down during these periods of US economic weakness. So if we continue to see recessionary economic data appear in the US, it would likely spell trouble for global equity markets as well. That being said, just one bad number doesn't guarantee that that's the direction the data is heading into. In fact, we see multiple examples on this chart of temporary weakness in goods orders that occurred outside of recessions and were ultimately resolved to the upside. Only time will tell which one it's going to be, but with this type of weak economic data on goods orders and on the unemployment rate, you can understand why investors are starting to panic. In order to calm down that panic, we would need to see something that proves this was just temporary weakness. Now, there is one argument for this. A hurricane hit Texas in July, which significantly impacted the job market and may have contributed to temporary economic weakness. Nearly 500,000 people were reported not at work due to bad weather in the month of July. This is the single biggest impact on employment numbers going back to 1976. So the hurricane in July almost certainly had an impact on July's unemployment rate number. If that's really the case, it could be that this spike in volatility was just temporary, like many that we've seen before, and will actually prove to mark the bottom of this market correction that we've seen over the last few weeks. Only time will tell which it's going to be. You can trade pretty much any global stock market index around the world at Capital.com.